Good day, everyone! We're back again to give you something you might want to know. Do you plan on getting up a business? Or are you a business owner at the moment? This video might be helpful for you. And this is all about fixed asset. In a business, fixed asset is of core importance to acquire. Fixed assets refer to long-term tangible assets that are used in the operations of a business, which also provides a long-term financial benefits. This includes buildings, property, land, equipment, and machineries. It is very difficult to think of a business without any fixed asset, because fixed assets have become part and parcel of the business. Many businesses require machinery or infrastructure which will help in producing a larger amount of goods and services. This will help the business generate a greater amount of revenue and will also significantly increase the profitability of the company. Also, the greater the number of assets of the company, the greater will the valuation of the company is. The fixed assets also help the management of the company to divide the business into departments. Each department will handle a particular amount of fixed assets. And if there is any mismanagement, then the department will be responsible. This move will help in the easy management of the business. Now, let us learn more on the fixed asset system. Fixed assets has also life, and this can be described through a flowchart. In the screen, you can see a flowchart of the fixed assets transactions, from acquisition to maintenance down to its disposal. These transactions have sub-processes which we will talk about in the rest of the video. First, we have the fixed asset acquisition. Asset acquisition usually begins with a departmental manager recognizing the need to obtain a new asset or replace an existing one. Authorization and approval procedures over the transaction will depend on the asset's value. The fixed asset acquisition request now goes to the purchasing department. Here, the purchasing department will find suppliers. Department managers typically have authority to approve purchases below a certain materiality limit. Capital expenditures above the limit will require approval from the higher management levels. This may involve a formal cost-benefit analysis and the formal solicitation of bids from suppliers. Once the request is approved and the supplier is selected, the purchasing department now passes the purchase order to the supplier or vendor and a copy of the purchase order to the accounts payable department. The supplier who receives the purchase order now delivers the asset to the company through the receiving department. The supplier also delivers the supplier's invoice to the company's accounts payable department. The receiving department, having received the asset, now creates a receiving report and reports the asset to the accounts payable department and delivers the asset into the custody of the user or manager, which is rather than a central store or a warehouse. Then the fixed asset department, not inventory control, performs the record-keeping function. The accounts payable department, having received the copy of purchase order, the supplier's invoice, and the receiving report from the receiving department, then authorize payment of such acquisition to cash disbursement department. The accounts payable department also forwards an asset cost data to the fixed asset accounting. After, the cash disbursement department will post the cash disbursement voucher to the check register and release the said voucher as the payment to the supplier. Then, a journal voucher from the acquisition will then be posted to the general ledger. Here's a summary flowchart of the asset acquisition, from acquisition to posting to the general ledger. Next stage is the fixed asset maintenance. Asset maintenance involves adjusting the fixed asset subsidiary account balances as the assets depreciate over time or with usage. Basically, asset maintenance includes identifying, tracking, and controlling assets. It is essential to keep track of these information or data so that when the asset is disposed or transferred to another entity, subsidiary, or department within the entity, information is readily available to interested users. The process of such is the following. After the asset has been acquired by the department, the clerk will receive a registering asset report from the receiving department and the asset cost data from the accounts payable department. These reports will provide evidences that the assets are received and shows the costs of such. The clerk then creates a ledger or file to keep track of the acquired fixed asset, and that is to be called asset maintenance. Information encoded includes its type, location, cost basis, operating condition, location, etc. After the clerk has listed those, he then prepares a depreciation schedule. Common depreciation methods include straight line, sum of the year's digit, double declining balance, and units of production. Most of the information needed to set up the asset for depreciation is available at the time the invoice is entered. Information entered at this stage includes acquisition date, placed in service date, description, asset type, cost basis, depreciable basis, etc. Asset maintenance also involves adjusting asset accounts to reflect the cost of physical improvements that increase the asset's value or extend its useful life. Such enhancements, which are themselves capital investments, are processed as new asset acquisitions. Finally, the fixed assets are distributed throughout the organization and are subject to risk from theft and misappropriation. When one department transfers custody of an asset to another department, information about the transfer should be recorded in the fixed asset subsidiary ledger. Each subsidiary record should indicate the current location of the asset. The fixed asset accounting department then creates a journal voucher to be reported to the general ledger. Lastly is the fixed asset disposal. When an asset has reached the end of its useful life, or when management decides to dispose of it, the asset must be removed from the fixed asset subsidiary ledger. It begins when the responsible manager issues a request to dispose of the asset. Like any other transaction, the disposal of an asset requires proper approval. The disposal options open to the firm are to sell, scrap, donate, or retire the asset in place. A disposal report describing the final disposition of the asset is sent to the fixed asset accounting department to authorize its removal from the ledger. The disposal report formally authorizes the fixed asset department to remove from the ledger an asset disposed of by the user department. When the clerk deletes the record from the fixed asset subsidiary ledger, the system automatically, first, posts an adjusting entry to the fixed asset control account in the general ledger. Second, records any loss or gain associated with the disposal. And third, prepares a journal voucher. A fixed asset status report containing details of the deletion is sent to the fixed asset department for review. After, the fixed asset department will post a journal voucher to the general ledger. To conclude, these controls should be remembered. First, fixed asset acquisitions should be formal and explicitly authorized. Each transaction should be initiated by a written request from the user or department. Second, supervisors must also ensure that fixed assets are being used in accordance with the organization's policies and business practices. For example, Company vehicles should be secured in the organization's motor pool at the end of the shift and should not be taken home for personal use unless authorized by the appropriate supervisor. And lastly, the internal auditor should verify the location, condition, and fair value of the organization's fixed assets against the fixed asset records in the subsidiary ledger. In addition, the automatic depreciation charges calculated by the fixed asset system should be reviewed and verified for accuracy and completeness. System errors that miscalculate depreciation can result in the material misstatement of operating expenses, reported earnings, and asset values. And that concludes this session of All About Fixed Assets. Thanks for watching!